Artificial intelligence is supposed to make everything cheaper. So why are Federal Reserve officials now warning that the AI boom could help keep inflation high and even push interest rates higher? The short answer is timing. AI may eventually help workers produce more in less time. But before those productivity gains arrive, companies are spending enormous amounts on data centers, chips, power equipment, construction, and software. That creates demand today for resources that cannot always be produced quickly. In other words, the economy may have to absorb the expensive construction phase before it receives the cost-saving productivity phase. That distinction matters for almost every financial decision involving interest rates. Mortgages, credit cards, business loans, bonds, and growth stocks could all be affected if the Federal Reserve decides the AI investment boom is adding too much heat to an economy where inflation is already above target. Most people hear that AI is deflationary. The basic argument makes sense. Imagine an accounting firm where one employee can process 20 reports a week. New AI tools help that same employee process 30 reports with no loss in quality. The firm can now produce 50% more output with roughly the same labor input. That can lower the cost per report. It can also allow the company to expand without hiring at the same pace. If similar improvements spread across logistics, manufacturing, medicine, finance, and software, the economy can produce more goods and services without using proportionally more labor and capital. More supply relative to demand usually reduces inflationary pressure. But that is the finished version of the story. It skips the cost of building the technology. A useful way to understand the problem is to imagine an economy that can comfortably complete 100 major construction and equipment projects this year. Normal demand already accounts for 95 of them. Then technology companies arrive with plans for 15 additional data center projects. Demand is now 110, but near-term capacity is still only 100. Companies start competing for electricians, engineers, turbines, transformers, cooling equipment, land, copper, concrete, and advanced chips. The result may not be 110 completed projects. The immediate result may be higher wages, longer waiting lists, and higher prices for scarce inputs. The AI boom is therefore capable of producing two opposite effects at different times. Investment spending can be inflationary now, while the technology created by that investment can be disinflationary later. This is no longer just a theoretical concern inside the Federal Reserve. Its July 2026 monetary policy report said inflation had risen during the year and identified increased demand for some AI-related high-tech products as one contributor. The report also said manufacturing had been supported by demand connected to data center construction. The Fed's target rate remained between 3.5 and 3.75% after its June meeting. And if you enjoy explanations that connect big economic stories to everyday money decisions, consider subscribing. That is what this channel is here to do, without the market hype or impossible predictions. Now, one data center by itself does not create nationwide inflation. The concern is scale and concentration. Many projects need the same limited categories of equipment at roughly the same time. A chip fabrication plant cannot appear overnight. Power generation and transmission projects can take years. Specialized workers cannot be trained instantly. Even when companies have enough money, the real-world supply response may be slow. Credit adds another layer. When companies borrow to finance AI infrastructure, they increase the demand for capital. If trillions of dollars are chasing a limited pool of savings, market interest rates can face upward pressure even before the Fed acts. Federal Reserve Governor Lisa Cook made the concern unusually explicit on July 15th. She said the data center buildout had added heat to the economy and that AI-related capital spending had produced significant price increases in areas including chips, high-tech equipment, software, and utilities. She also stressed that announced projects suggest substantial investment demand may still be in the pipeline. The key word is announced. Not every proposed project will be completed, and spending estimates can change. So this is a risk, not a guaranteed inflation forecast. The pressure also becomes more difficult to interpret when AI investment collides with other shocks. Tariffs can increase the domestic price of imported chips, electrical components, machinery, and construction materials. Energy disruptions can raise the cost of powering data centers and manufacturing equipment. Higher fuel costs can then spread through transportation, food production, and shipping. The AI boom does not have to cause all of this inflation by itself. It may simply add another source of demand at a moment when important supplies are already constrained. That creates a difficult decision for the Fed. Central banks often look through a temporary price shock. If oil jumps for a few months and then falls, raising rates may do more damage than good because monetary policy works slowly. But several overlapping shocks can become persistent. Businesses may repeatedly raise prices to cover higher equipment and energy costs. Workers may demand higher wages to protect their purchasing power. Consumers and companies may begin expecting faster price increases. At that point, what began as a group of temporary price jumps can turn into continuing inflation. Fed Vice Chair Philip Jefferson described the timing problem on July 16th. If AI-driven investment and consumption arrive before AI-driven productivity, inflation may rise. If the productivity gains arrive quickly enough to lower production costs, the pressure could move in the opposite direction. This does not mean the Fed has decided to raise rates at its July 28th and 29 meeting. The June minutes show a genuine debate. Officials unanimously held rates steady, but some saw a case for an increase. Many participants said tighter policy could be appropriate if inflation remained elevated because of strong AI demand, tariffs, or the Middle East conflict. Others still saw scenarios in which inflation cooled and rates could eventually remain steady or fall. So what would higher for longer rates mean outside the Fed meeting room? Start with borrowing. The federal funds rate is not your mortgage rate, but it influences financial conditions across the economy. If markets expect tighter Fed policy, yields on government and corporate debt can rise. Banks and other lenders may then charge more for mortgages, car loans, credit lines, and business financing. Consider a simplified mortgage example. On a 30-year loan of $100,000, excluding taxes and insurance, a 6% interest rate produces a monthly principal and interest payment of about $600. At 7%, it is about $665. That is roughly $65 more every month for each $100,000 borrowed. On a $400,000 mortgage, the difference is around $260 a month. Bonds face a different problem. When new bonds begin offering higher yields, older bonds with lower fixed payments become less attractive. Their market prices generally fall. Suppose you own a 10-year, $1,000 bond paying 4%. If comparable yields rise to 5% immediately after you buy it, the bond's estimated market value falls to roughly $923. You can still receive the promised payments if the issuer pays and you hold to maturity, but selling early could lock in a loss. Growth stocks can also be sensitive to higher rates because much of their expected value comes from profits projected far into the future. Investors calculate what those future dollars are worth today. A higher discount rate makes distant profits less valuable in present value terms. That does not mean every technology stock must fall when rates rise. Strong current profits, better forecasts, and investor enthusiasm can offset the effect. It means higher rates create a tougher valuation hurdle, especially for companies whose profits are expected many years from now. There is also a deeper possibility. AI could eventually raise productivity while keeping the economy's normal interest rate higher. If companies see more profitable investment opportunities, they may want to borrow and invest more for many years. In economic terms, that could raise the neutral interest rate, the rate that neither stimulates nor restrains the economy. Jefferson noted this possibility while also emphasizing that the neutral rate cannot be directly observed and is extremely difficult to estimate. So how would we know whether the inflationary stage is actually temporary? First, the supply of chips, power equipment, construction capacity, and skilled labor would need to catch up with demand. Prices for those inputs should stabilize rather than accelerate. Second, completed AI projects would need to produce measurable efficiency gains outside a small group of technology companies. Businesses should be producing more per worker or lowering their cost per unit, not merely spending more on computing capacity. Third, inflation should cool across a broad range of categories. Falling prices for one chip or one energy product would not be enough if services, housing, wages, and other goods continued rising too quickly. Finally, inflation expectations would need to remain anchored. People and businesses must continue believing that the recent price pressure will fade, rather than treating rapid inflation as the new normal. And one common misunderstanding is worth clearing up. When economists say AI may lower prices, they often mean it may lower inflation. Those are not the same thing. Lower inflation means a product that costs $100 might rise to $102 instead of $105. It does not necessarily mean the price returns to $95. Productivity can slow future price increases without reversing all the increases that happened during the build-out. That is the central tension. AI can expand what the economy is capable of producing, but building that capacity requires real resources first. If spending races is ahead of supply, the road to cheaper production may temporarily run through higher inflation and higher interest rates. The eventual result depends less on impressive demonstrations and more on delivery. Can the new infrastructure produce enough real output to justify its cost before inflation becomes persistent? If there is another money or economics question you want explained next, leave it in the comments.